my biggest criticism of other people that say come from a like-minded approach, as we may, is they are actually pessimists on the future but still want to make money, if that makes sense.
Yes.
Okay?
Yeah.
In other words, all the world could go to hell and I still make a profit. And I think what I've learned, and to your point, is that the arc of humanity is so bright, and therefore the error of not only investors at certain junctures, but people that like buying things attractively priced at other junctures are that they tend to not think highly enough of the future or not hold as owners long enough in that future.
So I think one of the bravest things intellectually that Warren Buffett did, which he did, I believe at the behest of Charlie Munger, was to give up buying cigarette butts on pavements.
Sure.
And to go from being someone who would only buy stuff which was dirt cheap, where the cash value is higher than the price, etc.
Yeah.
To saying the value lies in what this company will do in the future.
Correct.
Not what it. That was an act of enormous courage and enormous imagination as well.
Yeah.
And because you can take the absolute, Benjamin. So Buffett is not a Graham and Dodd guy in the pure sense by a long shot. The idea of buying great companies at good prices and being willing to pay good prices for great companies, means that you are making. There's an act of faith. There's an act of imagination.
Yep, I agree. And but you to your point, there's a hope and a willingness to dream is how I think about it.
Yes, that Coca-Cola will continue on its trajectory. The moat is deep enough that it's that I'm willing to pay more than whoever sold me the stock.
Well, so let me because so I'm going to tie this into my next question. So Vernon Smith's work is in your book. Okay, he said, quote, all traders might well be rational, but if this rationality is not common knowledge, traders might speculate in the pursuit of capital gains and bubbles might arise, end quote. Okay. So my question I was going to ask was how can rationality not be common knowledge? But in the context that you're explaining it there, let me go one step further and I'd love you to kind of use Smith's idea with this. I agree with everything you're saying. One of my problems is so does everyone else. Okay? In other words, the idea that you go out and buy great businesses in the long run. And so the market adapts because markets do adapt. They're complex, but they're adaptive systems, so they adapt. And I think the amount of uncertainty they're ascribing to that idea is higher than they predicted. And therefore, what we're going to find out is that because the uncertainty was higher for what they were doing under that rationality, is that the outcome is worse than they thought. And I'll use Coca-Cola as an example. Okay, Buffett bought it, I think, he bought it in '87 originally, and at the time, what he was watching was the returns on capital of the business. And I think the return on equity of Coke went from like 25% within a couple years. It was at like 50%. He bought more. Because again, he was saying, gosh, for the returns on capital the business doing in the bright future, people don't understand this. So then in '98, he called Coke and Gillette the inevitables. Okay, and obviously Gillette today is part of Kraft, and Coke is still a standalone business. And what coincided with him saying that was obviously the late 1990s, and it ended up being that Coca-Cola was part of that bubble. It was part of this idea that in the long run you buy common stocks, and Coke's a long-term winner, and let's just overpay for great American businesses like we tend to do at Manius. And Buffett, a couple years after that, said, hey, here's the deal. I should have been selling the stock. Because when I said that, it was ultimately his lack of uncertainty that he was exposing. But the truth is the uncertainty was far higher. Now, again, Amar, I under this framework that you're saying, because again, how can rationality not be common knowledge? I have walked forward. We have looked and said, okay, let's just say that when Buffett said that in 98, he had sold the stock. How would he have done to today? And the answer is Coca-Cola has underperformed the S&P 500 for 27 years. Okay? And so again, to your point, I tend to think that when people talk about Coke as kind of like that good example, and I'm sitting there like, that's a terrible example. That's a terrible example because again, in many respects, like no one uses American Express for that, but American Express was a better example of again, having faith that the returns on capital and the brand and the future of the business was far greater. And so the reason why I say that is because watching people crowd into stocks like that today with these uncertainties, like, wait, they're buying the 27-year bad story at what I would argue are expensive prices. And even though there's good attributes of that business and there's good returns on capital, it still might be a 27-year bad story.
Yes. And so you have to be always cognizant of two things, but you can't be too cognizant of them, which is that in human affairs, you're always making a judgment.
Correct.
All judgments are fallible and all judgments are transient. They're not necessarily transient from one moment to the next.
Correct.
But things change. That is, so what is a great business today may not be a great business 5 years from now.
I agree, but we like heuristic things, right? As you talk about in your book. So we like, that old rule of thumb, just follow your heart. Well, that might be a terrible idea in certain situations.
Yes.
But we use it all the time. I want to show a chart here because I want to show this because obviously it's from your book and I thinking about some of these paradigms we're talking about. So I use your chart. Again, thinking about uncertainty on the y-axis and investment and complexity on the x-axis, okay? Thinking about this across the investment sphere. So, you talk about like a true like bootstrap company, you have your angel backed, you have your VC funded, and you have your public company prospects. Can you talk about as you go out, particularly on the x-axis? I think a lot more about the x-axis on this than anything. Because a company that's public is less likely to fail because it's got funding and ability to access funding, which is obviously different than the bootstrap company. But can you kind of talk about this paradigm that we have here up in graph form?
So, lurking behind this graph is the source of capital. So, if you are a bootstrapper and you're starting a business entirely with your own money, then you can do what you want. And therefore, you can get into businesses where there's very little evidence about what the prospects are, the genuine prospects for making a profit are.
Yep.
So that is one extreme. But unless you happen to be Charlie Ellison's child, you typically don't have a whole lot of money to put to work.
Correct.
So the size of your enterprise is going to be small, and typically in small enterprises tend to not be very complex.
Sure.
At the other extreme, you have, let's say, Microsoft in its current time, or a Coca-Cola, or an American Express, where by this time you are a fiduciary for quite a large number of diffuse stockholders with whom you have no contact.
Sure.
And so they would hope that you are a reasonable manager, but they can't really know this. So what they are betting on at the bottom is that you have a good management process in place to not have you go crazy. And that good management, and so this combination basically does several things. One is that it means you have a ton of public investor dough, and so you can undertake projects which are ginormous. Ginormous projects also tend to be complex. They have tons of moving parts. I mean, think of the supply chains, think of all the people working in a variety of functions, and then your managerial process helps coordinate that. But then equally, the managerial process is fairly demanding of evidence.
Mm-hmm.
And to the degree that it demands evidence, you will not do the crazy stuff
Sure.
which the individual entrepreneur can do. This does not mean, so if you put up that chart again, you'll see that it's not zero on the y-axis. It would be, it is still above, it's still a non-zero uncertainty on the y-axis.
Yeah.
But it is simply less. And so the challenge for the public companies to allow for a certain amount of uncertainty, to allow for a certain amount of judgment, but yet put in enough checks and balances that people feel confident that you're going to do a good job. Sometimes this means that you will be late. I mean, the interesting thing to me, example of this is actually Apple. Apple is never on the bleeding edge of technology, or has not been on the bleeding edge of technology since, let's say, the early 80s.
Sure.
It always waits until things have shaken down, and then it comes in full force where everything is buttoned. And what I find today is that the chart that you displayed has broken down, and the world. I'm not just now talking about the financial markets in which you invest.
Okay.
I'm talking about what companies are doing inside them.
Sure.
Has gone completely haywire because everybody has told them AI is the future.
Yep.
And there's absolute confidence that if you don't invest in AI, you're toast. And in my personal experience of having tried to use AI or actually large language models for ever since they came out, if there's one of those few things which I feel confident about, is that a very large proportion of the investments that these companies are making are going to go up in smoke.